Welcome to StokTok's deep dive into Wells Fargo and Company. Wells Fargo is one of the 4 largest banks in the United States, providing consumer banking, commercial lending, mortgage origination, and wealth management services across the country. At the time of recording, shares are trading at 81.41, sitting closer to the lower half of a 52-week range that spans from 63.4 on the downside to 97.76 on the upside. The RSI 14, a momentum indicator that measures buying and selling pressure on a scale of 0 to 100, sits at 49.4, which is effectively neutral. The 50-day moving average is 82.61, and the 200-day moving average is 83.91, meaning the share price is currently trading below both key trend lines. That is a structurally cautious technical setup. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Wells Fargo generates revenue primarily through net interest income, the spread between what it earns on loans and what it pays on deposits, as well as fee-based services across its consumer, commercial, and corporate banking divisions. Its competitive moat rests on its enormous deposit franchise and deep retail distribution network. The StokTok score comes in at 31 out of 100, which our model signals as a void. Breaking that down, Valuation scores 4 out of 20, Financial Health 7 out of 20, Profitability 6 out of 20, Growth 6 out of 20, and Smart Money 8 out of 20. Across all 5 dimensions, the picture is challenged. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio, what investors are paying today for every dollar of past earnings, stands at 12.56 times. On the surface, that looks inexpensive relative to the broader market. The forward price-to-earnings of 11.64 times confirms the street expects modest earnings improvement ahead. However, the PEG ratio, which adjusts the price-to-earnings multiple for expected growth, with a reading above 1 suggesting the growth does not justify the premium, comes in at 2.19. That is a meaningful flag. The EV to EBITDA metric, which compares enterprise value to operating cash earnings and is not applicable in standard form for banks due to how they account for interest, is not a useful lens here. The price-to-sales ratio stands at 3.06 times. Turning to intrinsic value, the GuruFocus Value, an independent fair value estimate, sits at 69.57 at the time of recording versus the current price of 81.41. That implies a margin of safety of negative 17%, meaning in our view the stock is trading at a premium to its estimated intrinsic worth. Wall Street analysts at the time of recording have a consensus mean target of 96 across 23 analysts, with the range running from 85 on the low end to 113 on the high end. That is a buy consensus. The next earnings report is due July 14th of next year, with the street expecting earnings per share of approximately 1.71, with estimates ranging from 1.63 to 1.83, a near-term catalyst worth monitoring. Relative to large-cap bank peers, Wells Fargo trades at a modest discount to institutions with fewer regulatory overhangs, though the sector has historically commanded similar single-digit to low-teens price-to-earnings multiples. Market sentiment around Wells Fargo, as of the creation of this video, leans moderately bullish, supported by broader bank earnings resilience and a constructive equity backdrop. In our view, the valuation setup is mixed. The multiple is not demanding, but the premium to GuruFocus Value and the elevated PEG ratio warrant caution. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that scores profitability, leverage, and operating efficiency signals, comes in at 6 out of 9. That is a respectable mid-range reading, suggesting the business is not in financial distress from an operational standpoint. However, the Altman Z score, a model originally designed to estimate bankruptcy risk, where scores below 1.8 indicate elevated distress probability, registers at 0 for Wells Fargo. It is critical to note that the Altman Z score is not directly applicable to banks and financial institutions, as they carry structural leverage and balance sheet compositions that differ fundamentally from industrial companies. The model was not designed for this sector, so that reading should be treated with significant caution rather than alarm. On the capital structure side, the cash-to-debt ratio is 0.81, meaning the company holds roughly 81 cents of cash for every dollar of debt, which is typical for a large deposit-funded institution. The debt-to-equity ratio stands at 1.21, reflecting the inherent leverage that is a normal feature of banking business models. Interest coverage, the ratio of operating earnings to interest expense, is not applicable in the traditional sense for a bank, where interest expense is a core cost of doing business, not a financing overlay. In our view, the balance sheet reads as structurally sound within the context of regulated banking, though the leverage profile demands ongoing monitoring. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, a measure of how effectively the company deploys capital to generate returns, is not reported in standard form for Wells Fargo, as the metric is structurally complex for deposit-taking institutions, where the capital base and asset base blend in ways that differ from industrial or technology companies. Gross margin and operating margin, which measure profitability before and after operating costs respectively, are also not meaningful in isolation for a bank, where the revenue line itself is a net figure after funding costs. What we can anchor on is the net margin, which stands at 25.6%. For a large universal bank, a net margin above 25% is a reasonably healthy signal. It means that for every dollar of revenue generated, Wells Fargo retains roughly 26 cents as profit after all expenses and taxes. The area that gives us pause is the free cash flow margin, which comes in at negative 22%. Free cash flow margin, the percentage of revenue that converts to actual cash available to the business after capital expenditures and operational needs, being deeply negative is a red flag that warrants further investigation into capital deployment and regulatory capital requirements. The return on equity is 12.02%, and return on assets is 1.05%. A return on assets of approximately 1% is considered the baseline standard for a well-run large bank. In our view, the profitability picture is mixed. The net margin holds up, but the negative free cash flow margin is a meaningful concern. On to growth. Is this business expanding, and at what rate? Over the trailing 3 years, Wells Fargo has delivered revenue growth of 4% in aggregate. Over the trailing 5 years, that figure improves to 7.6%. To contextualize those numbers, in an environment where interest rates moved sharply higher, which mechanically boosts net interest income for banks, a 5-year revenue growth rate of 7.6% is modest rather than compelling. It suggests that the underlying organic growth engine, stripped of rate tailwinds, is not particularly powerful. Book value per share growth, which measures how much the net asset value attributable to shareholders has grown, and is considered one of the most important long-term value creation metrics for a bank, has expanded at 8.2% over the trailing 3 years. That is a more constructive signal, indicating that despite muted revenue growth, the company has been building intrinsic per share value through retained earnings and share repurchases. On dividends, Wells Fargo currently yields 2.15%. That is a modest but real income component, not a yield that drives a conviction income thesis on its own, but a meaningful contribution to total return in a low-growth environment. The data suggests a business growing at a measured pace, with book value accumulation as the more credible long-term value driver. We would want to see revenue growth acceleration before upgrading the growth profile. Now let's talk smart money. What institutional capital is actually doing with this name? 27 top-tier gurus currently hold Wells Fargo in their portfolios, which indicates the stock maintains a presence on the radar of serious value-oriented managers. However, the direction of recent activity is worth examining carefully. Tweedy Brown, a value-focused firm with a decades-long track record of disciplined capital allocation, holds Wells Fargo at 4.21% of their portfolio, but recently reduced their position by 3.82%. Christopher Davis of Davis Advisors, a well-regarded long-term-oriented manager, holds the stock at 3.46% of portfolio and has been adding up 6.06%. Richard P. Zena of P. Zena Investment Management holds it at 2.79% of portfolio and recently reduced by 2.32%. Francis Chu of Chu Associates holds the position at 2.75% with no change. Harry Byrne of Sound Shore holds it at 2.73% and has also trimmed slightly. So the picture among major holders is mixed, one meaningful buyer in Davis, but several reducing. On the institutional side, only 15.8% of 13F filers, the institutional investment managers required to disclose holdings quarterly, are net buyers. A reading above 50% would indicate broad institutional accumulation. At 15.8%, the data suggests net institutional selling pressure. Insider ownership stands at just 0.27%, meaning management owns very little of the company relative to its size. In the most recent 3-month window, insiders recorded 0 purchases and 3 sales. Following the smart money here, in our view, does not present a compelling accumulation signal. And finally, the verdict. Let's bring it all together. On valuation, the trailing multiple looks modest at first glance, but the stock is trading at a 17% premium to the GuruFocus Value estimate, and the PEG ratio of 2.19 suggests the growth available does not fully justify the current price. In our view, valuation is stretched. On financial strength, the Piotroski score of 6 is acceptable for a large bank. The balance sheet leverage is structurally normal for the sector, and we do not read the Altman Z score result as actionable given it is not designed for financial institutions. The foundation is adequate but not exceptional. On profitability, the net margin of 25.6% holds up, but the deeply negative free cash flow margin of negative 22% is a concern that we would want resolved before building conviction. On growth, revenue is expanding at a measured pace over 3 and 5-year periods, and book value growth of 8.2% over 3 years is the most credible value creation signal. But overall growth is not a differentiating factor here. On smart money, the combination of low insider ownership, 0 insider purchases, 3 insider sales, and only 15.8% of institutional filers as net buyers paints a cautious picture. In aggregate, the StokTok score of 31 out of 100 reflects a setup where multiple dimensions of the analysis are flashing yellow simultaneously. Based on what we see in the data, this warrants caution, in our opinion, and we would want to see improvement in free cash flow conversion and a clearer institutional accumulation signal before the thesis becomes more constructive. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Wells Fargo and Company. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.